Is up, everybody? Andrew Cady here with Eric Rosberg. Appreciate you guys jumping on with us this Friday afternoon. Welcome.
Andrew, it's so good. It's so good to see you.
Yeah, it's another great day. I know it's Friday afternoon. We normally do this on Saturdays, but Saturday schedules get a little tough. Eric and I are both parents, and like tomorrow morning, I am doing a chili contest, a chili cook-off with my 11-year-old daughter at her school. And so I know Eric's got all sorts of like soccer practice and all sorts of stuff that's going on. So we figured we'd hop on Friday afternoon. Hopefully you guys can join us here. Open it up by saying if you have questions from whatever platform you're joining us, we're live on YouTube, live on X. We are live on Facebook in multiple platforms. LinkedIn, drop a comment. We'll be able to see it here and answer your questions if you have questions. Kind of talk housing market, housing programs, what's going on with the mortgage industry. What can we expect over the next couple of weeks until we do this show again? But Eric, where do you want to kick it off today?
I would love to start this off because you put something on social media. Was that yesterday?
Yesterday.
Yesterday, and there has been over 100 people have commented on this. And I know we have a lot of real estate agents in the audience right now. So tell us a little bit about that post, and and then
Yeah.
let's dive into that.
Yeah.
Super
So, for me, I'm always on a quest to perfect what we do. I feel like we've got a really dang good process. We've got a really good system where, we're never satisfied. Like we want 13-day quarter to closes, not 14. Like we're bummed if we're hitting 15. When I feel like our process is good, but I'm always looking to perfect it. So I asked the question on social media yesterday. I said, realtors, what's the biggest frustration you have dealing with your local lenders, not the online ones, but your local lenders? And man, did we get a firestorm of questions, and honestly, a lot of them really, really good frustrations. And some of them I really wanted to address even here today because some of them are a bit of a misconception about the lending industry. And that's I think it's important to get clarity on some of these things. Like there was one question that was asked: the biggest frustration is a lack of transparency in pricing. Why can't you? And I'm paraphrasing the answer, but Kurt Stein, good friend of mine, put it out there. He owns a home inspection company, and he's like, we transformed it by just being super transparent on our pricing. Why can't you just put your interest rates on your website where the client can plug in what their information is and it will spit them out their rate? And the answer to that is there's way too many factors that go into what impacts a client's interest rate. And I think it's a good topic to talk about because so many clients, we get the question, I'm sure you get it all the time, Eric, where someone says, what's your rate?
And I'm like, that's one of the top questions.
What's your rate?
Yep.
And what we have to understand, there's actually a laundry list of what all feeds into it, but just taking some of the top items on it. If you're the type of property you're buying can impact your interest rate. If you're buying a single family residence versus a condo, a lot of lenders charge an overlay in pricing for a condo. And so you end up with a little bit worse pricing in condos. Why? Because there's higher risk involved with a condo. With a single family home, it's the lender and the borrower. With a condo, it's the lender, the borrower, the HOA. The extra layer of risk is, what if that homeowners association ends up going bankrupt? And now you have a property that can't be sold because the homeowners association is belly up. And so there's an additional layer of risk. So there's additional layer of pricing. Another thing that's going to impact, obviously, you've got credit score, how much of a down payment you're putting down. But there's also things that come into play, like your income versus the area median income of where you're buying your home. So there's a lot of, so we deal with in the mortgage industry something called loan level pricing adjustments. It's called an LLPA for short. Yeah, so it's LLPA, loan level pricing adjustment. And loan level pricing adjustments, they come into play all over. Like if you have a 620 credit score versus a 700, Your worsening in pricing or a higher interest rate is because of an LLPA. There's also LLPAs for a condo. There's LLPAs for investment property or a second home. There's LLPAs for all sorts of things, whether it's a refinance or a purchase, whether it's a cash out or a regular refinance.
Mhm.
There's LLPAs that just stack layer and layer deep. Even LLPAs when you bump over certain DTIs. If your DTI goes
Yep.
too high, your debt to income ratio goes too high, then you get another LLPA. And those all impact the rate or the cost of an interest rate. And if you're buying and let's say you make there's certain programs where if your income is less than 100% of the area median income for the zip code you're buying in, then the LLPAs get waived. And so it's there's just simply too many metrics to put into place to say, hey, if you answer these three questions, I'll tell you what your interest rate is. It's just there's so many factors that come into play. And for us, the worst thing we could do is set false expectations to a client. The worst thing we could do is tell them based on the limited criteria we picked up from them, your interest rate's going to be a 7%. But then we find out that, well, it's actually going to be an investment property, and they think their credit score is at an 800, but it's actually a 722. Oh yeah, well we've got to readjust your interest rate, and then you have upset people. So this is why it's
Mhm.
important to get ahead of the game, get with a lender, and start the pre-approval process. Eric, what am I missing there? I know there's a lot of
So,
other things that come into play.
another thing, let's say hypothetically we have somebody's all their information and we give them a rate at 10 o'clock in the morning. It can change at 2 o'clock or 4 o'clock in the afternoon. The markets are shifting. So it's really, and that just kind of piggybacks on what you were saying. It's really hard to just be, I don't want to say we're not transparent, because when we get into locking, then everything's fully transparent.
Of
But to
course.
be able to, be able to give somebody an exact rate, just put it out there on online, is impossible. So
It,
just
it, it is impossible. And then you factor in, and let's just be very honest. Two things that can impact the interest rate you get is your income and your credit score. And the vast majority of consumers, and trust me, I have closed thousands of home loans. The vast majority of consumers do not know what their mortgage FICO score is. They know what Credit Karma tells them. And even if they pay and get their FICO scores, they're likely looking at a FICO 8. People don't realize there's a bunch of different variations of FICO scores. And in the mortgage industry, we use a FICO 2 for one credit bureau, a FICO 4 for another, and a FICO 5 for the third one. Very few consumers know what their mortgage FICO score is. And unless you know that exactly, your interest rate's not going to be correct. You also have self-employed buyers that, I mean, we see it all the time. I make $200,000 a year. Well, what do you actually report to the IRS? Well, I reported $41,000 to the IRS. Well, you make 41, and that impacts your debt to income ratio, which impacts your pricing. There's just far too many things that happen out there for it to be, one of those, we just, what's your rate? Oh, our rate is this. I trust us. We wish it was that easy. Like we wish we just got one rate sheet a day at 9 o'clock in the morning that everybody got the same rate and that was good until 5 p.m. It would make our life a whole heck of a lot easier than dealing with the amount of stuff we have to do here.
You mind if I brag about the Epic team real quick?
Do it, bro.
Because I've seen this, because for everybody, so we have a workplace chat. So where everybody on the team is talking. And I've seen it where somebody has removed a borrower because we had, say, a husband and wife, they had plenty of income. With one, they still qualified. It brought them under the AMI, lowered their interest rate. Talking about credit rescores, somebody comes to me and they say, "Hey, and I pull their credit and they're a 779. Why do I need to do a rescore, right? Because I know if I get them up 1 point, it's going to adjust those LLPAs, and it's going to be a lower rate." So there's a lot of cool things that I've witnessed, I've seen, I've done, and I just wanted to throw it out there that
No,
that
and
that's
it's the
huge.
truth. It's the truth. I use the term creative financing all the time. And I think that term's got a really bad reputation from 2005. Like when I say the term creative financing, I'm not talking about, oh, we're going into gray areas. No, we're getting creative. Like, hey, husband and wife are buying a house. Let's look at if we just used the husband on the application because he's got a 4-point higher credit score and it bumps them underneath of the AMI limits and it waives all their LLPAs. You could save a client thousands and thousands and thousands of dollars simply by getting creative with the information you have. And we see it all the time. Lenders just like they'll shop a quote with us and they'll come to us and be like, hey, this is the quote I got. And I'm like, yeah, that loan officer doesn't know what they're doing because we'll take this and we'll move this here and we'll change this and we'll take one borrower off the application and we can get you this deal. And the other loan officer is just dumbfounded as to how we're giving the rate and fees we're giving. And it's not because we're maybe even necessarily better priced than the other loan officer. It's just we know the systems enough and we know the programs enough to say, hey, let's go back off of here and let's go back to square one and let's relook at this with a fresh set of eyes of how we can make the situation better for the clients.
And that's you had mentioned process early on. We have such a like again a little brag. We have such an amazing process where we have so many multiple people are looking at the loan structure before it actually goes in that it's so important to know these little things. Andrew, can I talk about oh my goodness. Another comment. I'm looking through these comments right now. And this one, Jennifer Lawrence. I don't know if Jennifer's watching. Negativity about rates in the market. No time for that. Can you make it work? Yes or no? I'm guessing Jennifer is a realtor.
Yeah, Jennifer, I swear, if anybody follows me on social media, I have beat this drum until it's broken. I have beaten the dead horse until there is no horse. I am so sick and tired of the negativity. Uh, it permeates everything.
No.
And I've said it. I posted a reel about it maybe a week ago. Like real estate agents, they want the ray of sunshine even when it's a dark day. Everybody wants the ray of sunshine. And if you in the industry as a mortgage loan officer can't find the silver lining and the good spot of something, might be time to consider a new profession because there's always a silver lining. There's always a good side of the market. Like right now, with interest rates ticked back over 7%, guess what we're seeing again? A bunch of seller concessions. Great opportunity for a buyer to get into the market, to get in and say, I'm going to get this house at somewhat of a discount compared to where it'll be if interest rates come down into the fives. And that's still the MBA's projection is by end of year, we see 5 handles. The market's going to go nuts. Seller concessions aren't going to be a thing. So no, let's get rid of the negativity. So Lee commented, and I'm just going to throw it up there because I love it. Lee's a fellow loan officer. He's amazing. Good stuff. Buyers are clueless. They need to be educated. Yes. That is why you see the banner that runs across the bottom: speed, communication, and education. Everybody in the mortgage industry says, I can close your deal on time. I have great rates and I answer my phone and I communicate. That's what everybody says. I'm fast, I communicate, and I've got great rates. Well, we decided to change it up and add education to it. It's why we do things like this. I'm a big believer in not only loan originators on our team educating the individual client, because so many clients are just, hey, here's your loan disclosures. They have no idea what program they're being put into. They don't know that they're being put in FHA. They don't know what they're getting. They're just like, oh, well, this is the best deal for you. Well, take the time to explain to the client
Explain.
why. Like it's not hard. If you're not actually educating your clients along the way, number one, you're going to lose that client down the road by someone who will educate them. But let's go beyond that and let's talk about educating the real estate agents. I put posts on Facebook like that
Mhm.
because I want to see what the frustrations are. And if they're a valid frustration, then it needs to be addressed. But if it's a frustration that isn't valid, like Kurt's comment, and is no knock to Kurt, he's not in the mortgage industry, he's a home inspector, but I'm going to at least take the time to educate why it's not possible. Why it's literally pie in the sky to think that that's something that can be done very easily. And so for me, I love educating. I love getting out there and diving deep. this is what this business should be about. So many people take it as a freaking hobby. They spend their days just slinging loans, and they fail to educate the consumer. I've always been a big believer that if you're an advisor to your consumers and your referral partners, this business is a very long-standing business.
Right. And it comes the my takeaway from what you just said is service. We're here to serve people. We're serving people with solution. The solution is a mortgage, which is simply a vehicle, as um, forget if it was Barry Habib or Renee Rodriguez said, it's a vehicle to purchase real estate. So it during that process, and you can Google this or go on ChatGPT. I think I did a post on this recently. Home buying is one of the most, it's in the top like 3 or 4 most stressful life events. If we can't if you're not taking the time to educate and make sure somebody understands, whether it takes 2 times, 3 times, 5 times, if you're not taking that time to educate and help your realtor partners so they can grow their business. I mean, I don't want to sound like a jerk, but you either reevaluate or change jobs.
I'll sound like a jerk. Get out of the industry. I mean,
Yeah.
here's the deal: is we deal with these scenarios every day, and I can see why people get callous to it. You know, when you're closing 5, 6, 7 loans a month, 10 loans a month. I mean, when I was in 2020, I was doing 50, 60 loans a month. It's a rinse and repeat business. It is just over and over, same thing over and over and over again. But you can never lose sight that person you're speaking to on the other end of the phone, there's a 42% chance that they're a first-time home buyer. 42% of all mortgage transactions are first-time home buyers. 42% chance that they have never been through this process. You may have been through it 500 times as a loan originator, and you get it, you know it. You're going to drop terms like DTI and PMI and all these things. They don't know what the hell you just said. Like
LLPA.
they're completely deer in the headlights. So slow down. Use the opportunity to, again, serve your client. Don't just be an order taker and get so fast that you fail to take the time to truly educate the consumer on the product they're getting. I mean, imagine if you walked into a steakhouse and you just said, "I want a steak." Waiter said, "Gotcha," and walked away. And you're like, "Well, you got 15 steaks on your menu." And he brings back a filet mignon. He's like, I got you a filet because I looked at you and you're a little overweight, and this has the least amount of fat content. And I just figured it's the best one for you.
Right.
And you've been like, "No, I wanted a T-bone. Like, this is exactly what I knew what I wanted was a T-bone, but you just walked away when I said steak." That's what the mortgage industry's gotten to be. It's like, "Oh, their credit score is at a 680. I'm just going to put them in FHA." Well, how about we look and see if they can get an LLPA waiver on conventional, and see if they maybe have an option to get a better financing option without any upfront PMI and lifetime monthly PMI for a similar rate and similar fees, and see if it makes financial sense, and then give the consumer the option and let them choose.
People love options. I love options, and I love to be educated on my options. I love everything you just said, Andrew, and I am stealing that analogy of the waiter comes and says, I want a steak." Um, talking about education, because we hopped on a few minutes before we went live. 5%, and I've had a lot of people ask me about this. I think it's a great opportunity to talk about multifamilies.
Yes.
Multifamilies, 5% down. It used to be, you want to share with us? If you
Yeah.
were buying a
So
multifamily,
yeah, for the longest time, this is talking about conventional loans. Obviously, if you're a veteran, you can get a 4-unit property with 0 down. Beautiful, amazing setup. Let's roll through the other programs before we walk through conventional. Like the VA multifamily is hands down one of the most brilliant strategies you can do. If you're a veteran, buy a quadplex. You have to live in one of the units for a year. Then you can move out, turn it into 4 rental properties. And yes, you can use your VA certificate again, and you can continue this cycle, and you can begin to build this portfolio out. It's wonderful, and there's a lot of caveats. We could dive deep into that. FHA allows you to buy multifamily with very little down as well. But FHA, if you go to a 3 or 4 unit property, the 3 units become very, very highly problematic,
mhm,
almost impossible to do. especially in today's interest rate environment. I won't say impossible, but I would give it a 95% chance of being impossible on an FHA 3-unit property. And here's why. FHA for 3 and 4 unit properties requires a self-sufficiency test. And what that means is if it's a 3-unit property, you have to live in one of the 3 so you can rent out the other 2. The fair market rent, the appraiser is going to do what they call a 1007, which is a rent schedule of what the projected rent for those other 2 units will be. Let's say that rent is $2,000 a month per unit. We can use 75% of that value, so $1,500 per unit, $3,000 a month for the other 2 units. That $3,000 a month has to be more than the principal, interest, taxes, insurance, and HOA cost and PMI cost of the payment of your triplex. And on a triplex, it almost always fails because there's not enough rental income. Quads, same thing, but you're getting 3 units of rental, 75% of what the appraiser projects, and they have a lot higher success rate because you get that extra unit of extra rental income. Same scenario, you'd have $4,500 a month to deal to cover the payment on your quadplex. And so FHA has multifamily, but FHA, it gets really tough on the 3 units, almost impossible. 4 units can be done, but you lose a lot to that self-sufficiency test. Conventional has always been 25% down on multifamily. Like they wanted big bucks down. And
Put it down.
and it was always because they assumed that people buying conventional multifamily was a strict rental property. It was just they were going to buy a 4-unit property and rent the 4 units out. Didn't matter if you were living in one or not. It was like, this is the way it was. Well, they changed that up. This was a while back, a year and a half or so ago. And if you're going to occupy one of the units on a, duplex, triplex, quadplex, up to 4 units, you now have a minimum down payment of 5% down. And so multifamily, if you've got, great credit, multifamily has always been that kind of thorn in the side because of the big down payment requirement. Now you can come in on a conventional loan, buy a quadplex, plan to live in one of the units, and you can use 75% of the rent from your other 3 units to offset the payment on your property. And that's a really, really beautiful thing. So you get to look at the rents. Now you can't count overage on rents as income, but you can count the rental and help reduce the liability of what that property looks like. To me, it's one of the best programs that has been put together for multifamily purchase in a very, very long time, in my opinion, since VA multifamily. The 5% down has opened the door for young investors to come in willing to live in a unit and call it their primary for a year and get 3 rental properties at the same time on a quadplex.
One of my I don't know if he's on here, Michael Brew. He's a local realtor here in Jupiter. We were talking about for now and forever. And what we're talking about right now is number one, financial leverage to build generational wealth. One of the best ways, and Andrew and I are in real estate, so we're not going to talk about stocks, right? Stocks, bonds, and that type of thing. But if you look at some of the wealthiest people in the world, they built their wealth through real estate. This is just such a phenomenal opportunity for somebody who says, "Listen, you had mentioned the younger buyers. Hey, I'm willing to live here for now. Maybe it's not my forever home, but I'm going to have a 4-unit investment property, and I don't have to come up with that 25%." House
Yes.
hacking made it easy.
Never been a better time. And here's the beautiful thing is, okay, so I buy a quadplex today, 5% down. I move into 1 unit, live there for a year. A year from now, I've got a quadplex that I could move out of that 4th unit and I could rent that 4th unit. Now I've got 4 rental properties, or I got a quad that's being rented. You really, unless you have a ton of income, if you've got a great income, you could do this every year. Buy a quadplex per year, move into it for a year, and just keep the cycle going. If income isn't super freely flowing, well, what you could do is live there for 2 years. And after 2 years, now you're going to have 2 years of rent schedules showing on a Schedule E on your taxes. And so now you have positive rental income that you can actually count as income from your other 3 units. And you could cycle this every 2 years on not a huge amount of income. And you could cycle this every 2 years. And in a 10-year window, you could own, what is that? Five quadplexes. You could own, yeah, you'd own 5 quadplexes. You'd own 20 doors. And that's not talking if you're making, again, I could throw a number, I could throw 500 grand a year out there, but if you're driving a Ferrari, it doesn't matter. You've killed your debt to income ratio. But
Yep.
if you've got great income and very low debts, there's a real possibility you could do this every year. You could buy one, live in it for a year because you're committed to the primary residence, and then a year later buy another quadplex, move into that one for a year, another year later do it again and do it again and do it again, because there's no first-time home buyer requirements on this. This isn't a first-time home buyer program. You can do this over and over and over again. And if you've got solid income and low debt, you could build a rental portfolio of 40 doors in 10 years doing this. Like this is the opportunity. If you're, I say young, I don't want to age discriminate, but if you're a young bachelor or bachelorette and you're like, you know what, I'm willing to slum it in one of these 4 units for a year, and I'm going to do this for 5 years, you could find yourself with a ton of rental properties at 5% down per complex. And that is really, really cool stuff. Any questions anybody has on this? I know we've got a bunch of viewers watching right now. But to me, it's one of the best house hacking things that's ever hit the market.
Even think about it this way too. Even if you only want to do one, you have no interest in having 40 doors. You live in one, you're living for free,
Yes.
pretty much. In all things considered, you're living for free, having other people pay for the property with
Yes.
with an initial 5% investment.
Yes. So let's shift gears a little bit and pull up. Let me pull this up real quick. So let's talk interest rates. It has not been. It's been another rough week in interest rates, or 2 weeks since we last did this show. Interest rates have ticked back up a little bit. And again, what's your rate? How we started this thing? Like I'm not going to sit here and quote a rate, but I'm going to tell you based on Mortgage Daily News, which is publicly accessible information. This is a reading on what the average is, what's being given out right now, just across the country on the average. Typically, this is going to have a little bit of a cost, like discount point involved with it. On a 30-year fixed is just over 7%, 7.08%. 15-year fixed, 6.56%. VA down at about 6.67, FHA 6.65, jumbos about 7.5, and that's what we're seeing now. We've had just like consecutive days, back-to-back days of not really good in the markets, and this is all due to our lovely Federal Reserve and their stance that they have taken on not wanting to cut interest rates very quickly. And then, so we had the Federal Reserve meeting where they held the monetary policy. They didn't raise interest rates, but then in the press conference, Fed Chair Powell basically said, we're going to kind of reevaluate how fast we want to cut interest rates. We don't think we're prepared to cut them in March. And then the next week, the Consumer Price Index report, which is a measurement of inflation, came out hotter than expectation. And that really sealed the deal, where investors now believe there's no chance for a Fed cut in March and a very, very little to no Fed cut in May at the May meeting. And so this higher for longer is playing out, and the bond market is not liking it. Bond market is going to translate into mortgage rates. And so mortgage rates are holding this 7% line. And it's not ideal. I mean, it's definitely put a pinch on the market, but I'll say this: there's business out there to be had. Like there is. Like, I take a look at our team. We are 5 pre-approvals away from February being our biggest month ever in pre-approved buyers. And this is 100% kudos to the activities of the loan originators on the team out there grinding it and stirring business up and keeping their faces out there and doing all the daily activities it takes to generate business. But I'm just saying there's business out there. February will be our biggest closing month we've had since 2021. In the month of February, and February is traditionally a very, very slow month. We're pending 36 transactions closing this month for just over $12 million. Already have 23 or 24 in for March, with another 7, 14, call it 15, 18 days to add for March. The market is there. The business is there. If you're not actively getting the business, you got to start looking at the daily activities we're putting out. And that's kind of my shift of gears, is to the old Bible verse, be not weary in well doing. It's been it's when you have a tough time in the market, you go 4 or 5 months in a tough time, and you're all all flowers and roses. Like, you know what, we're going to get through it. Everything's going to be good. But when that 4 or 5 months turns into a year, then a year turns into a year and a half, and a year and a half closes in on 2 years, there's a mental shift that can come into play. And if you aren't careful, you got to really dig deep and find the positivity and find that energy to go out and continue to grind, because the business is happening. There's a lot of buyers still buying that doesn't necessarily seem like a lot of reason they should, but they're doing it. And so get out there and get your lion's share of it. It's out there.
It is, and I know we talked about it earlier. Staying positive. It's there's less competition. Personally, Andrew, I think I shared this with you. Bridget and I just went under contract.
That's right.
W-
Yes.
and she knows I do this all day, every day, and she's like, should we wait for the interest rates to go down? And I said, we have an opportunity. Uh, we negotiated. We got to a little bit of seller credit. We got a really great deal. And I said, if something, if we wait, and we can wait for those rates to come down. So it's when you talk about, you had brought up a restaurant example before. So you want to eat at a place where the chef eats. And I'm sharing openly. I'm not afraid of the rates. I personally went out. I'm the chef. I'm the cook, right? So, and I'm eating the food. I think it's a great opportunity.
What's the analogy they say? Never trust a skinny chef.
Never, yes.
Yeah. So we're eating our own food here, and that's no, it's a good point. And congrats to you guys. I think the market is ripe for it. If there's seller concessions, if there's stuff on the table to get, I think it's a great opportunity to go out and get it. And yes, we've got to be positive. There's too much negativity in this world already. We don't need more of it. And if you're a perpetrator, or if you're, I can't think of the right word, perpetuating negativity in this world, rethink your strategy.
Mhm.
You know, honey attracts a lot more flies than vinegar. Nobody ever, you may attract an initial swarm of people that feed on the negativity, but even those people get sick of it after a while. And those people will always gravitate towards someone who has a positive outlook on life. And there's just no opportunity like right now for us to get out there. If anybody's got any questions, we're probably going to wrap this up here in about 5 minutes. I know Eric's got dinner plans tonight, and I've got dinner plans tonight. We're going to have a great rip roaring time. But if anybody's got any questions, drop them in.
I
But
have
I
a
think
few more. I have a few more pre-approvals to get to today.
well, let's knock them out. We're 7 away from our all time. We're at 67 pre-approved buyers for the month, and our record is 74. And we've got 6 more days to do this. There's no way we won't hit that.
Helping a lot of people. It's helping a
Yes.
lot of people right there.
It's, you know what? There's just something very, very happy about it. This industry, you can get jaded about it, or you can fall in love with the helping of families and what that feels like. And there's just no feeling like it. So I would say, to wrap it up, the market isn't as happy as we would like it to be. Although today it's coming back a little bit, which we hope would be a sign of where it might go tomorrow or on Monday. So we're ending the day. It looks like we're ending, as long as nothing changes, 15 basis points up, which is our first really good gain day in a long time
Mhm.
now. So I'm happy about that. Hopefully we continue that trend on Monday. we'll continue to kind of keep everybody abreast of what's going on in the markets. Follow us on social. Love to post a lot of stuff about Jerome Powell and how much I dislike him and think he's, never
Stay
mind, I won't
positive.
even go there.
Stay
Positive.
positive. Stay positive.
Keeping a positive train going.
He's
But yeah,
just
if there's no more questions,
he's just a little slow. Just a little slow.
he just doesn't get it. I mean,
Yeah.
let's just say this. If you're a reader and you want insight into our Federal Reserve, you need to read the book called The Creature of Jekyll Island. And you realize very, very quickly that there is nothing federal about the Federal Reserve. They're as federal as Federal Express. They are owned by the largest banks in America. The Federal Reserve is actually solely has shareholders, and the shareholders are the banks that the Federal Reserve governs. And so they own what they do. And it was very creatively created to create bailouts for the biggest banks and not the smallest banks, which is why you see the small banks fail. The Creature from Jekyll Island, if you're a big reader, it's a very big book, probably 1,000 pages, but it will blow your mind on how the Federal Reserve was founded and where it's at. But that's all I've got. Eric, you got any final parting words?
I hope everybody has a great weekend. If you're a realtor out there this weekend, reach out to your Epic mortgage advisor. I think all of us are working this weekend. We work when you work.
Agreed.
We're here to support you. And if anybody that's watching, you just have questions, you want to reach out to us, and you're like, hey, can you dive into that a little bit more? Pick up the phone. Let's have a conversation. We'd love to hear from you.
Phone numbers and emails right there. Reach out, guys. Appreciate you and have a wonderful day.
Take care.
See you.